So let's talk about doing more than one deal at a time. We'll start with a little about me. For those of you who don't already know me, my name's Brian Fine. I started being a real estate investor back in 2012 when I got fired from the last job I ever had as a IT tech, and figured that flipping houses sounded cool. So I joined a coaching program to learn how to do that. Was an absolutely awful student, didn't do a single thing they said, never attended a single coaching call. Hint, they don't work unless you do them. 2 years later, I got broke enough that I went back and started listening to them. And we started doing transactions. And we followed their systems well enough that within a few years, we'd scaled our business. And I was invited to be a coach, curriculum developer, and speaker over the next number of years. So we were doing tons of rehabs, buy and holds, private lending, raising capital, all that fun stuff. And at the same time, I was coaching and teaching a few thousand students between 2015 and 2020. Today, I focus more on the rental side. We're down to about 5 to 7 rehabs at a time right now, which is a pretty big pullback for us compared to what we used to do. But we acquire as many rental assets as we can. Today, that sits just over 300 residential rental units. I am the general partner in a private lending fund. We'll talk more about that a little later because it is brand new and will be set up and available early next year, early 2025. And I am in business with 3 absolute genius partners who don't do anything that I do. We don't have any crossover. So the jobs that they do, I do not. I'm focused on marketing, sales, and financing, while they're focused on things like project management and other aspects of our business. Outside of real estate, I like combative martial arts. I travel to Japan a couple times a year to get beat up by some old Asian folks, and I've been doing that for half my life. So if you want to talk to me about something that isn't real estate, that is certainly something you can bend my ear about just about any time you want. All right, a couple of quotes from a few relatively famous Americans. Andrew Carnegie, I am from Pittsburgh. He's a big Pittsburgher. 90% of all millionaires became so through real estate, and more money has been made that way than all other investments combined. Wise young man or wage earner today, invest their money in real estate. And then good old Mark Twain, buy land, they don't make it anymore. In the end, this is being a landlord. Purchasing real estate is the 3rd oldest profession, and it's going to be around for a very, very long time. There is no technological advancement coming up anytime soon that is going to alter the valuation of real estate. It's always going to have significant real value. So whether you're looking at this to make money now or as an investment vehicle that you're going to use for the next 50 to 100 years, real estate stands alone in how powerful it will be long term. All right, so we want to scale the multiple deals. It's unlikely that anybody is going to be retiring from just a few. You might hear some guru somewhere talking about doing some commercial deal somewhere where they made a few $1,000,000 and were able to quit after that. But if you're hearing the story, it's probably because they're doing books, being on stage, and continuing to do the business in some way. It is unlikely that anybody on this call is going to be doing a single transaction and then cashing out. We're going to need to do quite a few of these things over time, and we're going to want to build powerful systems to be able to do those deals on repeat. So when you go to scale your REI business, you're going to have a few predictable issues. All of them have to be kept up. First one is you're going to need a method to market for deals and properties. The level of complexity you have for this, I know many of you are already in different education programs. This is where most of the education programs focus most of their time, and it depends a bit on your markets, but generally at the moment in the current market cycle, you can probably buy what we would consider a real estate deal off the MLS in just about every market in the United States. You don't necessarily need an extremely robust off-market efforts in order to get a hold of some decent deals in most of the country. You're going to have to fund the acquisition. We'll talk about that quite a bit, but somebody somewhere is going to have to pay for this thing, right? You're going to have to do whatever equity improvement you're going to. As investors, we're trying to buy these things at a discount. That discount usually comes because there's problems. That could be problems with the asset itself. We're going to do some sort of construction. It could also be what we call a paper renovation. Maybe it's a rental property where the rents are well below market. Or maybe we can split a 1 unit into a 2 unit, or any number of other things that would increase the value of that asset as a investment. So some type of action you are likely to be taking to improve it. You're going to need systems so that you can do those improvements, whatever they're going to be. If it's a rehab, you're going to sell or refinance it. So you're going to need a good, solid sales system. And if you're keeping it as a buy and hold, it is also going to need leased and managed. These 5 things need to be in place for you to scale. You're going to need them all. If any one of them starts to fail, you'll have major issues. As far as I'm aware, there's no way around this. A big challenge that I've seen is that these things are never in balance. In the years I've been doing this, it's never worked out that I have enough of all of this. There's always some challenge somewhere. One of these is going to be out of balance with the others and threaten to upset your apple cart. And so as an entrepreneur, your efforts are going to shift, or you're going to have teammates assigned to each of these who are going to have to keep the plates spinning. All right, something you should all do and take a really good look at is get MAD. MAD is minimum acceptable deal. A fallacy that gets pushed a lot by your different education programs and gurus is that people tend to focus on the home run, grand slam, epic deal where you make a ton of cash. Especially when we talk about scaling our business, that's not how it works. You're going to make the majority of your wealth and control the majority of your risk on, if I stick to the baseball analogy, singles and doubles. It's stuff that barely makes it. You are not excited about this property. It checks all the boxes and doesn't have a reason for you not to do the transaction. So the less greedy you are about what a deal is, the easier time you will have finding them. All right, so I'll give you a couple of success pointers here. These are just KPIs that I would use to determine, is something a minimum deal? So here's a version for a rehab. We teach multi-day classes on this stuff that go into a hell of a lot more detail. Many of you already have education on that front, so I'm not going to go too deep in this. This is actually more from a lender's point of view. This is what the person cutting the check is going to want to see. For a rehab, you guys broadly can use the MAO formula in the majority of the country as long as the asset's worth less than about $500,000. So that's the ARV times 70% minus any repairs. That does not mean you will be making 30%. You're going to lose roughly half of that 30% in holding costs and selling costs, right? So there's a chunk coming out of there. So that formula in just, again, big picture sense, has you making about 10 to 15% profit margin on a renovation. Also, on top of that, you need to have a minimum dollar amount you consider acceptable. This is going to vary pretty heavily by your market. I'm in Pittsburgh. Average property I'm flipping is about $200,000. We want to make at least $30,000 or we won't touch it. So you want to have that dollar amount in there as well. And you guys should be running on something more detailed than that MAO formula. You should probably have a spreadsheet, a calculator, something that lets you figure out the exact dollar amount you expect to make at the end of the project. This is a requirement from your lender. This is actually a standard that is used by the bank's appraisers. You will need 3 hard comps, meaning that they have sold. It is not acceptable that they are under contract or listed or pending or any of those other statuses. They have to have been sold within the last 6 months. They need to be a similar construction type. They need to be in the same area. You can't cross any hard barriers like rivers or major highways, school districts, that kind of stuff. And then you want to round down. Use a nice conservative ARV for that. You will never be sad if you thought you were going to make less than you do. You will be very, very sad if you try to use the high ARV and you end up selling it for less. That is how we lose money. So nice conservative ARV, round down. Minimum construction is ideal. The old joke of paint and carpet or lipstick on a pig is very much ideal from a house flipping point of view because we want to do these things quickly and with minimum risk. So the less construction we have to get into, the less chance we have of cost overages and things taking longer, incurring additional holding costs, finding unknown stuff behind the walls, all those kind of things that make the entire genre of TV shows about flipping houses a thing. So the less construction we have to do, the happier we are. If your construction costs go higher than your purchase price, there's a term for that in the lending world. We call that an upside down rehab, and that is considered significantly higher risk. And unless you are fairly experienced at this kind of thing and have a nice solid construction arm to your business, you may want to avoid those. It's a particularly good idea. All right, for rentals, it's a little different. If you're underwriting a rental asset, I recommend you underwrite it in a 60-month pro forma. So you're looking to hold this thing for 5 years minimum. And this is going to be a lot more pessimistic than anybody who's ever told you about rental property before. But I'm somebody who, actually owns them and deals with them every day. So I can afford to be a bit more pessimistic. In years 1 or 2, now, yes, we're going to underwrite them so that, the expenses after everything versus the rent, there should be some level of cash flow in there. They have to, 100% of the time. But for me, I don't care if I underwrote it that I'm making, $200 a month or something on that property. For the first 2 years, if I don't have to write another check, I consider that a win. No unexpected repairs came up that I didn't account for when I bought the asset. No massive vacancies, no forced evictions, no nothing. If all I do is just keep the thing, have its holding costs paid, pay the taxes, insurance, mortgage, and any utilities I'm responsible for, and am good to go, then I am very, very happy with the underwriting that we did on buying that asset. So 2 years, don't make a dime, and I'm thrilled as long as it doesn't cost me anything. Years 3 and 4, I want to see more money than I underwrote originally. Now, we should have several years of rent increases at that point, so this should not be a difficult bar to hit. But then in year 5, we should have built enough equity and have enough additional cash flow that we can refi that property out. We can kick out whatever money we use to buy it, get a nice 30-year fixed mortgage placed on there. And then I would take 80% of the cash flow that is coming in on that property, and I would count it for my personal life, because tenants do things like don't pay, pay late, and everything else. So if you ever want to live on cash flow, if that is a goal of yours to build a massive rental portfolio that provides all the cash you need to live on for the rest of your life, understand that that cash is going to be unstable because tenants' lives are unstable. So you're going to need to round up a little bit. So in any state where if they don't pay, I can take possession of the unit through an eviction process, and under 90 days, I would add 80% of that cash flow to my personal life budget. So if I'm making $1,000 a month, I would consider 800 of that to be reliable money for me. And that should account on an annual basis for the time that my tenant doesn't pay me. If you're in a state that you probably shouldn't be buying rentals in, New York, New Jersey, California, Washington State, Oregon, those tenants can potentially stay and not pay for several years. At that point, the amount of cash flow, if you chose to buy a property there, that I would apply towards my income would maybe be 50% or less. So just account for that risk, because eventually it's going to happen. All right, how many rentals do you actually need? So here's a little calculator I threw together. We have an interactive version of this that we go through in our classes, but I set this one for the assumption that you want to make $200,000 a year. So if you want 200 grand a year in cash flow, the way that's going to work is I'm going to round that number up 20% for the exact reasons I just went over. We assume there's some instability. So if I need 200 G's a year to live, that is my retirement plan. That is the money I'm going to be feeding my family on, and going on my vacations and living my life and being a happy human being. Then I'm going to round that up 20% immediately to account for that difference. So I need $240,000 a year on a 5-year acquisition. This calculates using a series of assumptions what that requires. The assumptions we have when you buy these things, they are a 5 cap, 5% capitalization rate. For most of you on that call, this would be considered a minimum acceptable deal. This would be a not great rental. In most cash flow markets in the United States, you can pick these things up off of the MLS. This is not a special property. This is not phenomenal investments. This is basically just MLS junk. You can pick it up. Not hard to get. We're going to assume 5% appreciation, and we're going to assume that the income and expenses, both the rent and the taxes, insurance, and all the other stuff, all go up 5% a year. This is also assuming an 8% interest rate on a mortgage, and it's assuming that that mortgage is for 75% of the purchase price that you're using. Then it goes ahead and calculates closing costs, down payments, and everything else. So if I want $240,000 a year in cash flow based off those assumptions, I will need to purchase in 1 year $6.7 million in real estate. And after my loans and everything else, I will need just over $2 million in down payments and closing costs in order to buy that. So that is what it actually looks like. For some of you, that might be the first time you've ever tried to calculate that. So that's what it looks like at 200 grand. Obviously, you can shift the number in any way you'd like. It increases every year. But that gives you an idea of how much you actually need. So if you want to make $1 million a month, well, that's going to be 5 times that number, isn't it? So then I'm going to need about $10 million in cash, plus 75% note in order to buy these things and get them performing. So unless you got $2 million in cash, or maybe half that, right? Maybe we need $1 million or something. We're going to need some other sort of strategy in order to get the cash we need to hit these goals. So let's talk about the financing. How are we going to pay for all this fun stuff? For every deal, somebody somewhere has to write a check. I know a lot of you guys are involved in that, the sub 2 program. So a subject to transaction, in theory, could be nearly free. It's never entirely free, but you can get really, really close. Then who writes the check? The bank already wrote the check. The existing mortgage is the check that is written. So in every single deal, there will be financing or funding of some sort. So the term we use for this is the capital stack. And if you guys have never heard this before, do your best to learn it off of me now. If not, you can search on YouTube and find 1,000 little tutorials on the capital stack. So I'll try to explain it as best I can. But if you really don't get this one, learn it. This is financing 101. This is how any assets or any project is funded. It doesn't matter if you're talking about a $500 million skyscraper project or a $50,000 little shack somewhere. They're all included in the capital stack. Now, every deal doesn't necessarily use all the parts of the capital stack, but all the parts are present in every transaction. So going from the bottom to the top, this is risk and reward. So at the bottom, the senior debt guys, senior debt takes the lowest risk and gets the lowest reward. And usually when we think of senior debt, this is your first position mortgage lender. This is the bank. This is the hard money lender. If there's nobody else involved, this is a private money lender. They usually secure their position with a first position mortgage, and generally they're paying a big chunk. So you notice on this little graphic, the senior debt takes up the most space. They take up a big chunk. In conventional financing, they do not go to 100%. So there will be other pieces left. In fact, they very rarely go above 80%. I'll talk about why later. Above them, higher risk, but still a debt position, we have what they call mezzanine debt. Mezzanine debt is a really fancy word for any loan that comes behind first position. So it can be second, third, fourth, fifth, sixth, seventh, eighth. So any lender that comes behind an existing senior lender is called a mezzanine lender. Most of your senior lenders do not allow mezzanine lenders. They will tell you can't have them. There are exceptions to that. Most banks will allow some level of seller financing. But even then, there'll be limits on what they're allowed to do. So that side, this is the debt side. The debt side, very specifically, does not own the asset. They are not owners. They can cloud the title. They can put a lien on the asset, but they do not own it. So they are not owning real estate. That is not their business. The returns they get from doing this are interest. So these people are lenders. Above them, we have equity. Equity are owners. These are the people who actually get to own the thing. Preferred equity is a special case. You don't see this one very often. This one is kind of unique, but it's very important to us as real estate investors. Preferred equity is a loan that is secured by equity instead of by a mortgage. So let's say you're going to buy a house. You're going to buy that house with a first position lien, and then you want a private lender to come in and lend you that down payment. But the guy writing the first position loan, your hard money lender, is going to say, no, you're not allowed to do that. So what you can do instead is have your private lender own equity in the LLC that's buying the property. And their equity is treated as a loan. So it has loan terms. I'm going to pay you X amount of interest for X amount of time, and then I'm going to pay you back all your money. And in the event that they fail to be paid back, they will seize the remainder of the entity, all the equity, and become the owner. Okay? So as we're traveling up, the risk is higher than a debt person, and so is their reward, which means expect a higher interest rate. And then at the very top of the stack, taking the highest risk and getting the highest reward, are common equity. This is you. This is the actual owner. You are the last one paid. There's no guarantee you'll be paid at all. You're on the hook for absolutely everything, but there is no ceiling on your paycheck. You can make as much as you want. So all the risk, all the reward. That is the capital stack. We need to reach 100% of purchase price, closing costs, and holding costs through some combination of all of this. And that is how you will fund every deal you ever do, from the little ones to the giant ones. That's what happens. Every deal you've ever done falls into this model. So that is the capital stack. All right. Why would you do the debt side? Why would anybody? Why would your lender do it? If you want to borrow this money, guys, you need to understand what would make you lend it in the first place. Put yourself in the lender's shoes. A lender has to put themselves in your shoes. So we need to have some empathy for these two sides. The number one reason is it's a guaranteed return. The term guarantee, when used in this context, is a legal term. It's not a sales term. In a sales term, it's, you'll like this new car, I guarantee it. Well, that's bullshit. It doesn't matter if you like it or not, and there's nothing that you can do if that is not true. In real estate, in mortgage world, that is very different. A guarantee is a promise that can be enforced with a lawsuit, and so it is legally binding. It is a promise that can be enforced. There's substantially less risk. They don't care if you get paid or not. They don't care if you made money or not. They are still due all of their principal and interest, according to the terms of your note. It is a very stable reward. If they're getting monthly payments, they get those monthly payments no matter what. They never go up, they never go down, they get their payments. Think of the house you guys probably own and live in right now. Your bank gets paid whether you got your check this month or not. It doesn't matter if you're having good times, bad times, whatever. Bank gets their check or they will take your house. So they get paid every time, a nice, stable reward. In the event of a default, their position goes from debt to equity. And what I mean by that is they foreclose and take the house. So your bank, if you don't pay them, goes through a lawsuit enforcing the guarantee. And at the conclusion of that, they will take possession of the asset. That makes them the owner. So they shift from the senior debt position to the common equity position, and they become the new owner of the property. And so if you are a lender, that is not the outcome you want, because if you just wanted to own the house, you'd have bought it in the first place. But that is the security that backs you up. So you weren't getting paid correctly by whoever borrowed off of you. So we take back the asset where we can go ahead and liquidate it. We can sell it and recover back our money. And that is a secured collateralized loan. That's how they work. All right, why would we do preferred equity? Senior debt likes this structure better. If you're going to a hard money lender because you want to do a flip on a house and they tell you you need $60,000 to close the deal and you don't have that in your pocket and you want your buddy to give it to you, they do not want to see your buddy give it to you as a loan, especially not a loan that is going to be secured by a mortgage. They're going to tell you no. They are not going to mind so much if instead your buddy gets to own 5% of the LLC that's buying the house. That's totally cool. They couldn't care less. It is the same guarantee as debt. If you don't pay them, they take your entity, which means they own everything the entity owns, like the asset. It can get the same returns, though if you push them higher on the capital stack, which is typical, then it's fair for them to get a higher return. They're going to get a bigger interest rate on that. There's no foreclosure. There's no lawsuit, unless you really want to try to fight them, which I've never seen anybody do. Usually if you're failing to pay your lenders, it's time to give it up. They just instantly own your LLC. They take over and they can do whatever they want with it. So they will usually go ahead and move towards selling the subject property. So this is really just a debt position for a lender that is secured by equity. It's a great way to do it. It works in all 50 states. Mezzanine debt does not work in all 50 states. It has, depending on foreclosure law, it can be very, very risky. For example, in the great state of Texas, a second position mortgage isn't worth the paper it's written on. It's useless. It's basically an unsecured loan. And that's because of the way their foreclosure law works. The second gets wiped out in the event of a foreclosure. It's useless. So as a lender, I would never consider doing a second position in Texas. We would do preferred equity because that is a enforceable security. All right, why common equity? Why would we want to be the owner? Well, that's you guys, right? It's the highest risk, but it's also a shared loss. So a lot of you have probably been educated that you can joint venture. A joint venture is where everybody's common equity. So if we're making money, we make money together. If we're losing money, according to your ownership, you split the loss. If you own 60% of a property and I own 40% of that property, and we're taking a $10,000 loss, then I'll owe a $4,000 check and you'll owe a six. So all the ups and all the downs. You get the highest reward. We get to keep everything. You know, we buy a house for $200,000, we fix it up for another 100,000, and we sell it for $1 million. We just made 700 grand. Those kind of returns are impossible. They're considered usury in the lending world. We're not allowed to do it. But as a common equity holder, you can do it all day long. There's no limit to what you can make. There's also no limit to what you can lose. But the IRS likes you, at least as much as they can like anybody. We get depreciation and tax losses. So as a lender, we don't get that. But as a common equity holder, we actually get to write off the interest that we pay our lenders on our projects. We get the depreciation on that asset. So the value of the building, not the land, divided by 27 and a half years. Every year, we get that as a tax loss. So the money we make on these projects gets bled off. That's for rental properties, not as much for rehabs. Rehabs are income. We can refinance and sell these things, and we get to keep all the proceeds. So common equity can be very, very attractive as far as that goes, right? Refi proceeds are great. When you sell something, you're subject to a capital gain, or if you do it in less than a year. In some states, this is a little different, but in most places, it's a year. If you sell something, it's a capital gain if it's over a year, and if it's under a year, it's considered income, and you'll be taxed accordingly. If you refinance it, though, it doesn't matter what you refinance it for. It doesn't matter how big of a check the bank cuts you on your shiny new mortgage. That is a loan. That is not income. And you are taxed accordingly. The tax on a loan is nothing. Now, I have had a accountant point out to me that's not 100% true. If you do a lot of it, I mean a ridiculous amount, millions and millions of dollars of cash out refis in a year, there is a provision under which you have to pay taxes on it. It's a 2% tax rate. But for most of us, that will never apply. We get variable returns. When we raise the rents, we get to keep the rents, and we get principal pay down on those first position mortgages. So we get to keep all of the money, everything. This is every sexy thing about being an investor you get in common equity. You also get every risk of being an investor in common equity. If you take somebody as a partner in this way, they are both your cheapest and most expensive partner simultaneously. The risk and reward. They're your cheapest because if you don't make any money, you don't have to pay them anything. And they're your most expensive because they flat out get a cut of everything you make. When I started buying my rental properties, we started in 2020 during COVID. I bought my first 120 units with common equity money partners. I just flat out gave them ownership of all the properties I bought. And that is totally cool with me because half of 120 units is still a hell of a lot of rental property, isn't it? All right, here's one of your biggest challenges. When you are scaling up, the thing you want the most is to put no money into a deal. You want to get to $0 deals. One of the biggest challenges some of you have that haven't done their first deal yet is you're trying to do this on the first one. That's even harder. And you're asking a lender to take the highest possible risk on you. So you're asking them to be preferred equity or unsecured altogether because senior debt won't allow a second position. You're asking them to finance 100% of your cost, often including closing and holding costs. The objective is generally to have no skin in the game. Even if you have to put just like 5, 10K at every property, well, you only have so many 5, 10K chunks. So if you want to do 50 deals at a time, you'd need $500,000. We're going to run out at some point. So we want to get that number down to zero. Most lenders and most partners do not like it when you have no skin in the game. That is a higher risk for them. You often want to close quickly, as in sub 30 days, or I get a phone call on a Wednesday for a closing on a Friday. A lot of the deals we see when they're asking for this have the upside down renovations. Hey, I'm going to go buy a place for $200,000 and I'm going to put $300,000 into it and I'm going to sell it for $1 million. That's where that construction is more than a purchase price. From a lender or risk point of view, this is much, much riskier, much more challenging for us to be okay with. Then generally, because we want to keep our cost at zero, we want zero coupon, which means we want all the payments at the back end. Sure, I'll pay you whatever interest rate, but all your interest comes when I sell this property or refinance it. So now you're asking me to write you a check, trust you that you're going to get everything done right. You have no money in the deal, and you're not going to pay me until everything is settled out on the other end, all right? Or any other structure you come up with that isn't a monthly payment. That is a much higher risk from the point of view of a lender. On the other hand, here's what your lender wants. They want a first position mortgage. They want it every time. They want no other lenders involved. They want to finance you at 80% or less. Can anybody on this call tell me why 80% is the magic number? Why they won't go above it? Besides Mark, you're not allowed to answer, dude. Anybody?
More meat on the bone.
More meat on the bone. That's part of it. That's part of it. In the event of a foreclosure, the cost of the foreclosure, the time involved, the lost interest, and then that they're going to have costs in selling the property on the other side will cost about 20% of its value. So if I have a $100,000 house that I have to take back from you, I will make you a maximum loan size of $80,000, because if I have to take the $100,000 house back, the cost of my lawyer, the cost of listing and selling the property, and the time involved will mean I net about $80,000. That's why they do it. If they go above 80, then even taking back the property won't necessarily recover the principal. So that's why that's a magic number. All right, the remaining funds for the down payment and closing come from the borrower and are verified. The term is seasoned, as in they know that that is your money. You didn't get it lent from a friend. It's not mom's. It is yours, and it has been in your bank account for 90 or more days. They want 30 or more days to close. 30 to 45 is average for residential. Commercial is 45 to 90. They want an appraisal to confirm the asset's value. That'll be a third party. It's going to make sure, you might think it's worth $100,000, but a third party might come in and say it's worth 25. That would be a problem. So they're going to want a third party to confirm what they think that value is. They're going to want the monthly payments. The monthly payments to a lender are their communication from you that everything is okay. If they don't get their monthly payment, then they wonder what's up. So when you ask a lender not to give you a monthly payment, then it's scary for them because they have no idea whether or not their money is safe and the project is moving forward. So massive difference. Oh, and either no construction or a budget way less than the purchase price. They want to see a really small construction budget, not a lot. So there's a massive difference between what a lender wants you to have and what you need. We need that other 20% to come from somebody else because we don't have the money to do it at scale. And if we have to make monthly payments, we need that thrown in too, because otherwise, same thing. We're going to have to make these payments on projects that aren't making money, whether we're buying rentals that aren't rented yet, or we're buying rehab projects that are going to go 6-8 months before there's anything going on, before there's any money to be had. We'd have to be out of pocket for all that. So we'd have to borrow that too. So these are very conflicting places to be. The nice part about this, though, is this is the so-called 30-year fixed mortgage rate. So this is the cheapest money you're going to get. This is the baseline that determines what all other money costs, at least in real estate. So as of today, they're running about 7.5% for a 30-year fixed. That's owner occupancy numbers like an FHA loan. Generally, we're borrowing on a DSCR loan, which is about 1% higher. So you guys are looking at 7.5 to 8.5 as far as your interest rate goes. That's the floor. Everything goes up from there. All right, so here's a little model for you to figure out kind of what you should be paying. So if we start at the floor, let's just use 8. We'll split it. So 7.5 to 8.5 that's 8 for a median there, right? Everything you want off of this list means your interest rate is about to go up. You want to be brought to 100% financing. Oh, wait, there. Sorry, my list is out of order, apparently. First, you want the loan to go over 80%, loan to value. As soon as you ask for that, tick up the interest rate. You want them to make it so that you don't have to bring any money to closing, that you're going to get you to 100%. Tick it up again. You want them to close in less than 2 weeks. You don't want an appraisal, or a more accurate way to say that is you don't have time for an appraisal. This one would actually be hopefully pretty rare for you guys, but no BPO. That's a buyer price opinion. This means we won't even find a local broker to tell us what the property's worth. I can tell you that if you need me to check this box, this is going to be a big increase. You want us to do a second position or a preferred equity, and you want a first position in place. Then that second position money is going to cost more. You want short-term money. The loan's going to last a year or less. That's more expensive. You have light or medium construction. And then if you have heavy construction or upside down construction, tick it up again, higher risk. And if you want anything besides monthly payments, anything at all, that's going to cost you more too. So that's your list, guys. It also should be a wish list of everything you actually want, because it allows you to borrow all the money you need to do a deal without having a dime out of your own pocket. And only once you hit zero for your own cost on a deal can you do unlimited deals and scale. Now, to my earlier point, this is only 1/5 of the equation, but it's a pretty big fifth. If you can't afford to buy it, then none of the rest matters. All right. So who are the lenders that will do this kind of stuff, and what kind of structures can we use for it? It depends where their money is coming from primarily. If you're using a private lender and it's coming from a retirement fund, they have only a few options. There's only a few things they're allowed to do within the bounds of their retirement account without breaking the rules. They can do preferred equity with you. That's totally cool. They can do a straight up mortgage, first, second position. Please, for the love of God, nobody do anything past a second position. Don't do a third or fourth. That's unsecured. The chances of that lender losing their money are astronomical. So please don't do that. First position, second position, done. Okay, so they can do mortgages, and they can do a SAM, or a shared appreciation mortgage, which I'll have to talk about with you guys another time. That's outside the scope of this class. And then for all other funds, every other kind of lender, this is whether they're private, institutional, whatever, they can in theory do everything, but most of your institutional guys, your hard money lenders and banks, will not do much. So they can do preferred equity. Anybody can do that. And they can do mortgages. Most of your institutional guys will only do a first position mortgage. It is the only product available. You will not get another choice. They can do shared appreciation mortgages. You will almost never see them outside of private. And you can have common equity or joint venture partners, which is probably what most of you should be doing. You likely need that. You need those money partners to partner with you and hit kind of milestones. All right, so I've been JJ's friend for 6-7 years now, and a handful of us, myself, JJ, I think I saw Mark Abramovich on this call as well, and we're getting together and we're going to make a lending fund, because it's getting a little old to have to solve this problem and have nobody who's going to do it except private lenders. And the problem with private lenders, give you guys an idea, I have about $2.5 million in private money at any given moment. The problem with private lenders is they run out of money. That's their challenge. Even if you go follow all the systems you've been taught and go find all these folks who are willing to do these investments, they only have so much capital. And so it becomes a major scaling issue for us. And they run out of money. As the prices of these houses increases, which has happened a lot since 2020 and will continue to happen moving forward, especially for the next 4 years, it gets harder and harder to have a private lender who can simply write you a 100% mortgage. They can do one, but they're probably not doing 2, 3, 4, or 5. And so we need more and more folks to do this, and it gets more and more of a challenge to find them. So when we scale, it makes a lot more sense to spread the private money out. The hard money lenders, nice part about them, they don't run out of cash. I don't have to worry about the giant capital fund suddenly not having money to fund my $500,000 rehab. They have it. They have the cash. And they're a bit cheaper, honestly. Their rates are very competitive. So I can take my private money and use it in a preferred equity position or a second position lien and make it go a lot further, about 5 times further. But even then, if you guys really want to scale up, you're going to need a private lender who can do all this magic stuff for you and have the money to do it quickly and regularly. And so we're getting together, we're going to do a private fund. Our private fund does a couple of things. First, you'll be able to invest with us because we're very experienced investors. So if you'd like to put money into this fund and see a return out of it, that is fine. Asterisk by this, I'll be doing a whole call on this. JJ will be announcing it, and they'll tell you what the name of it is and everything later too. You have to be an accredited investor to do this part. This is regulated by the SEC. There's a whole bunch of rules we have to follow. That is one of the really big ones. Only an accredited investor may invest in this CPF. But all of you will be able to borrow off of us. We will happily, with a big smile on our face, be your private lender in first, second, or even preferred equity position. All that magic stuff I just talked about, yeah, we do that. And as far as I am aware, there is not another fund or institutional lender anywhere in the United States that will, much less that would advertise it. So we're going to be taking up a rather unique place in the market. And those notes that we write you, we will sell them. So if somebody wants to turn around and buy those off of us and get a nice return for the next couple of years, or we're going to do 30-year fixed too. You can get returns in a retirement account for 30 years on those and triple your money. You want to do that? Cool. We'll originate the loan. We'll take care of everything, and then you can just buy it back off us. No problem. So we'll be able to do all this stuff with you guys ongoing, and this will begin early next year. We'll have this fund ready to go and probably ready to make loans by February. We're also going to be offering some education. That's going to help you guys out as well, because, if you're borrowing our money at a higher risk position, we want to see you do well. So we're going to provide coaching education to investors if you want to scale your REI business. We know that part. The general partners in this fund are very experienced. And if you want to be a private lender, well, between the lot of us, we've been professional lenders quite a while as well. So we know that part and can help you avoid losing money or making massive mistakes. So if you guys want any kind of education on that front, feel free to reach out. We can have that conversation as well. All right. So that is it for my little presentation today, guys. What questions do you have for me?
Brian, this is Felicia. Let's go back to what you were saying about taking the notes and selling them. What did you mean by that?
All right. So question was, what did I mean by buying notes? So let's pretend, Felicia, that you have a property somewhere and you want a 30-year mortgage on it. It's a rental. So you come to us and you buy a 30-year fixed mortgage. So we're going to go ahead and lend you the necessary amount of money to do that, whatever. You're very happy. You're making your payments. Actually, the tenant's making your payments, and you're living your best life as a landlord. Now, in the fund that we have, I have X amount of dollars out with you, and they're going to be there forever. Well, I'd like to get that money back. So what we will do is offer that for sale. So somebody somewhere, private individual, might want your loan. And so we'll offer it for sale. So they will pay us the same amount that we lent you. So let's say I lent you $100,000. They'll come and buy that loan off of me for $100,000. Your servicing remains the same. You'll get a little letter telling you it happened, but nothing will change. You'll pay the same place. It'll all be handled. So for you, it's a seamless thing. But for the person who bought the loan, they will begin receiving the interest and principal payments as it goes. So nice and powerful system there. Seamless for the borrower, but offers some great opportunities for the people who want to buy performing notes. Another way to do it is if it's a short-term note. Let's say it's a rehab note. So we're writing a loan that lasts less than a year. You're going to buy it, fix it, and sell it. So I lend you X amount of money, whatever that is, to do your renovation. And then I can offer that note for sale. That's a short-term one. And the way we do that is slightly different because there's not a long enough time for there to be an interest rate where we make some money on it. So we change the IRR. So if I lend it to you at, let's say, 15%, 14, 15%, they might buy it off of me at 12, and it'll be adjusted the difference. So it'll cost them a few $1,000s more to buy it. So they'll be able to buy those loans off us on an ongoing basis. You do not need to be accredited or anything else. There is no requirement beyond that you're able to afford them as far as buying notes goes. But it's an entire investment genre where these things are originated by professionals. They know what they're doing. Normally, notes are sold all the time. You probably, if your bank did a mortgage for you, there's every chance that was sold to somebody already and you didn't even know. Usually happens at an institutional level, like giant banks buying billion-dollar packages of these things at a time. But we'll sell you just one. And we're also going to be making loans on very small properties, which is another thing that most lenders won't do. I don't mind writing a loan on a $50,000 renovation. So you'll be able to pick up some notes that are rather cheap and perform quite well. So it should be a thing that's rather unique in the market. We don't see anybody big doing this.
Yeah, I just had a quick question about that 30-year amortized loan, and you had the 27.5-year
depreciation schedule.
Depreciation.
Mm-hmm.
What about the sped up version? That's a shorter time frame.
Cost segregation.
Yes.
It's a totally separate strategy. You can do it anytime you want. Traditionally, it's done to commercial buildings, but there are plenty of services out there now. There's at least a dozen floating around the country that will do it to single-family property. They do charge a hell of a lot, though. So it really only makes sense if you have a bunch of cash you need to bleed off capital gains on very quickly, and you're going to do it for a portfolio because the price tag on it is rather high. So you're going to need to be able to justify $20,000-$30,000 in raw cost to do it, and have enough savings to make all that math make sense. The other thing to keep in mind, cost seg is great. It's a phenomenal choice. You can think of it as a 0% loan from the government that you only pay back if you're stupid. But what I mean by that is if you ever sell the property, you're getting hit for everything. There will be a massive capital gain on that. So you're never selling. You can do a 1031 exchange, but it will carry all the depreciation forward with it. So once you've burned that depreciation, you're not getting it back.
Hey, Brian. So I was curious. I know you were focused more on the rental side. Does this lending focus more on one strategy than the other, like a BRRRR or fix and flip or the buy and hold?
So yeah, our fund, no, we won't care. It'll be fine either way. But all a BRRRR is a rehab with you as the end buyer.
Mm-hmm.
So it's the same thing. And so the way that would be financed is you would get a rehab loan to do it, and then you would refinance it into a long-term hold product. Now, in theory, like a private fund like us, we could do that. We'd give you a rehab loan, and then we just roll the money over. It would be a paper change. It would be super easy. But most of the time, you swap. You end up with a different lender out of the deal.
Okay, and so when lending, say, you're suggesting get like a first position and second position, so get like two lenders when you're working on it?
Yeah, you need some way to get to 100%.
Wow.
You got it, right? Otherwise, you have money out of pocket. And the problem with money out of pocket is we always run out. I don't care how much or how little you have, you run out. And we can't scale on running out. So you need a method to hit 100. I do them all because the resources are different, right? We don't have one answer that fits everything. I run out of my answer. I run out of guys who do second position. They only want to do preferred equity. Okay, fine. I run out of guys who want to do that. Now I got to take a joint venture partner. So we do everything. And certain deals lend themselves better to one strategy than the other. It's harder to use a second position lender on things that don't cash flow really, really well. It's a very, very big challenge because there's no money left to pay them. What are you going to pay them with? You're going to end up in the red. You're already given 90% plus of all your income and expenses to the first position.
Okay.
So there's nothing left. What are you going to pay the guy with? And they're taking a higher risk, so they should have a higher interest rate.
Yeah. Yeah, you don't want to screw yourself, no.
Yeah. Well, nobody's going to agree to it. It's not even about screwing people over. Just as soon as they understand what the structure is, they're just going to say no. So it's like, yeah, I'm not going to do that. You have to pay me better. So we need ways to make them comfortable with that. And you want to be fair. We want these things to be win-wins every time. So yeah, you're going to use all those methods, but by far the easiest for pretty much everybody is if you're just starting out or something is going to be the straight up common equity partner. Just give them some ownership.
Okay.
Let them have all the upside, all the downside, and try not to cry when you have to write them a giant check later.
Question for you. So I'm going to ask you the no question first, and I'll get to the yes question.
Okay.
It sounds like you only do residential, not commercial, right? For this fund?
Debatable. That is
Okay,
that is not 100% my call. So I would lean towards not so much, but my partners may very well disagree with me. So.
Okay, because I do self-storage, so I mean, this would, if I get a seller carry deal, I may need $500,000, $1 million bucks, and it'd be a 5 to 7 year hold.
Yep.
Okay. Wow. Okay. Yep. So I was expecting that one to be a no, but that's a yes. So the second one,
it's a maybe, but we'll take a look, right?
All right. So here's question number 2 that'll be easier. I'm in SoCal. I'm helping Pad Split open up here, and I want to start cranking these things out. So with that, obviously, I would need a down payment plus a little bit of rehab. You have to do the walls and a little bit of this, a little bit of that. And I'm a GC, so that's not hard. Would it work for something like that?
Yes. For us, the only concern, I don't really care what you're doing with it. Okay. My concern is the security I have on it. So with something like a pad split or any kind of split ownership kind of deal, I'm going to want a first position lien. Because basically in the event it goes south, I need to be able to take a collateralized property, not a piece of one. I need the whole damn thing so I can liquidate it. So as long as I can get there, sure, we can make it work.
Okay, but well, okay, so where I'm at, Orange County, I mean, our prices are going to be 1.2 million ballpark.
Okay,
You guys gonna go up that high?
potentially, yeah.
Okay. So
Yeah.
if it's 1.2 and I'll need, let's say 50, 75,000 for fix up and all that. So yeah, be in it. The hard part is if I'm buying it for 1.2, I mean I can buy a fixer and do the same thing and
Mhm.
have built-in equity, but then you just need a little bit more cash. Maybe
Yeah,
not. Maybe not in this scenario. Um,
it's
so if I'm
that
in it
was
for 1.2, I'd maybe be in it for like 1.275, maybe 1.3.
mhm.
But the income will be probably it'll be 1% easily because I can get about $1,500 to $1,800 per room. And if you get 7 rooms, I mean it's like 12 grand a month.
So what you probably do is we use a just a standard hard money loan for first position there. We could come in as a preferred equity in a second and maybe make up whatever gap you have on that, as long as the numbers work. Mostly because I'm not going to want a $1.3 million exposure on a single note because we're not raising that much money, at least not initially. So we'll let the guys with the giant checkbook write the big chunk. We'd take the smaller chunk and be perfectly happy. But when you're done and you have it performing, you got all that cash flow, you're going to kick everybody out. You'll kick us out and the hard money guy and get a long-term DSCR loan that'll take that position.
Right. Or I could do a sub two and then,
You,
then maybe I need
you,
like 250,000 or something.
yeah. So, but sub two is the same as just having existing senior debt.
Right.
It's just another.
Yeah.
The bank's already there, and you're not asking them if
Right.
it's okay. It's really all that you're doing.
Right. Yeah. I was just because the hard money loan, I talked to Kiavi
Hmm.
and they're
Yeah,
not
I know them.
crazy about it because they feel if they get that property back, they have to undo what you did. And
Yep.
and there's a few lenders out there that are starting to recognize the co-living model. And I'm having the owner of Pad Split come out to my sub two group in December. I'm going to talk to them about some of their lenders, but because I mean there's obviously loans for VRBOs, but co-living just hasn't hit the mainstream yet.
Yeah, the modification of the living arrangements and basically screwing with the zoning, it becomes a problem. And it messes with the collateralization in the event we have to take it back. That's why everybody's shying away from it. It's as a business model, it works fine, but in the event that it collapses, it doesn't sell that way. It needs to be converted back to just a straight up house and sold, and that's an issue.
Yeah, but it's funny. I had a conversation with one of the higher ups at Pat Split or a couple days ago, and I said, I think obviously California is a blue state. I think blue states are better than red states because we have such a shortage and there's such a need. The government wants to help, where some of the red states,
Yep.
like in Fort Worth, you can't have more than 2 or 3 cars per house that aren't related, and they're shutting it down. Well, California, you could build a 40-unit apartment building on a 12,000 square foot lot, low income, and you have zero parking.
Yep.
It's nuts.
Yeah.
So.
It again. I mean, California is a massive quagmire, so it would be a conversation to be had. We'd have to understand how we're secured would be the question. So it's not a no, but it would be something we'd have to understand how, if it failed, how do we recover our principal? Because in the end, I'm raising other people's money and I'm lending it out. They're trusting that I get it back. So we have to be able to stand up on put the hand on a stack of Bibles and say, we did everything we could to make sure this was okay. So that's something we got to get to. So not a no, but it would have to be a conversation.
Wow. So I have 2 maybes.
2 maybes. Sorry, that's the best I can do at the moment. You're asking me a lot of stuff that we need lawyers to answer.
Gotcha. So obviously you're doing a 506c fund then, right?
I believe so. Yeah.
Yeah. If you use an all credit.
Yeah, it's easier that way. Much
agree.
easier. A lot fewer loopholes to jump through.
So when you raise private money, what has worked best for you as a business practice that you can share with everyone else on the call on how to raise private money, from the people around them?
Fantastic question. So first, let's disclaimer Mark a little bit. If you guys don't know him, he's the other general partner in the fund. He is a professional lender. So if you need money, he should be your phone call. That's your hard money guy. And I would strongly suggest using a broker because you definitely want somebody to stand as a buffer between you and the underwriter. And I'll give you a simple, before I answer Mark's question, let me give you a reason for that, though. I think this is really, really important. If the policy with lenders is that you have to answer any question they ask you. You don't necessarily answer questions that they don't ask you. That doesn't help. But anything they ask you, you need to answer them. And depending, if you lied, that can be construed as mortgage fraud. So this is jail time stuff, not slap on the wrist fine stuff. We never want to cross that line. So when we're dealing with large institutional lenders, it is a phenomenal idea to have a broker that you have a direct relationship with. Because when they ask uncomfortable questions like, hey, where's the money for this down payment coming from? Since your checking account has $12 in it and you need $45,000, where's that at? If I don't answer that question just right, and it is the lender themselves, the underwriter asking it, then I am potentially committing mortgage fraud. With Mark or somebody like him, I can have a conversation and be like, well, here's where it's actually coming from. And I don't know, we really want to have this talk. And he can help me formulate a response that will be acceptable to all parties involved. There's a bit of a buffer there. If you do it yourself, it's all the risk. So I do recommend having a nice broker between you and, just put a little picture in there. Yeah, having a bunch of cash under a mattress is phenomenal proof of funds. I love it. But that is something I recommend you guys do. You should have a good relationship with an ongoing hard money broker. And you want a really easy way to underwrite deals. Don't abuse this one too much. But a really easy way to underwrite deals is send it to a hard money guy and have them tell you no. And guess what? That's not a deal. Because if the high risk hard money guy can't fund it, it ain't a deal. There's just no universe in which that is considered acceptable risk by the people who take all the risk. So something to keep in mind. So best practice for raising private capital. I'm going to go back to what JJ says all the time. Is you need to build a network of people before you need it. If you open the conversation with, hey, I'm borrowing private money, are you a lender? The chances of that succeeding for you are vanishingly low. Most of my lenders have known us for more than 3 or 4 years. They'll attend a webinar I do, meet me online, we'll have a virtual cup of coffee over a Zoom, and we will do no business of any size, shape, or form for years. They're just lurking in the wind, waiting to see if I'm going to be one of the good ones. Because at the same time, I'm sure you've seen it in great groups like JJ's, and there's a few others where lenders have gotten burned and somebody's ran off with their money and really screwed things up for somebody. They want to make sure that you've been around long enough that you are known to have not done that. If I start screwing over my lenders, every one of you will know within a few days. It's a very small room to gossip in. So you want to get to know these people ahead of time. Make them comfortable with with the business you're doing, put yourself out there before you have the ask for the money. And that's going to increase your chances of success by quite a bit. Now, us as a fund, you can treat Mark and I as your rich uncle if you want. We're going to have a system for how much we like you. It's going to be how many deals you did, but we will be here and have a established way of offering you these things that you can only get from a private lender. So thank you so much for joining us today. If you are not in JJ's group, make sure you join the Facebook group. That's a really big deal. He probably runs the best online networking group in the world. It probably has the most active members, one of the best places to not just find money, deals, but basically build out your Rolodex of the people who are going to help you to be able to get your business where it needs to be. Just like I said at the beginning of this presentation, you are not doing one deal and being happy. It's not how it works. As soon as you do one, I don't care how much money you made. Hopefully you didn't lose any. I don't care how much you made. It won't be enough. You're going to need some more. And so you're going to want systems in place. And those systems are going to require people. You're going to need your network first and foremost to be able to solve those issues. So join his group, do the networking, Everything JJ says is absolutely correct. You guys just need to do more of it. I promise. So I'm in JJ's group. You guys will have no problem finding me. Brian Fine, Fine, just like it sounds. My phone number's on the name here. It's 412-212-6627. I respond to text messages. You can text me anytime you want. But Facebook works great. You can message me on there anytime you want. We can set up a call. I'd be happy to chat with any one of you at any time about any of this real estate stuff. I hope you all have a wonderful Saturday.